On September 15th, 2008, a financial bubble exploded and kick-started the Great Recession. It's remembered as the day the Lehman Brothers filed for bankruptcy, the stock market had the largest single-day point drop since 9/11, and it was the day the world finally had to confront that a major bubble had burst. In this case, the housing bubble.
What in the world is happening on Wall Street?
What came next was a series of hardships for people globally. Homes foreclosed, jobs lost, retirement funds tanked. But what worries me is that we have not learned our lesson. If you've seen The Big Short, a movie that chronicles the housing bubble's burst, you'll know that at the end they mention how the big banks went back to selling the same exact junk assets that caused the burst in the first place. But if you can believe it, that is not even the potential bubble that I'm talking about today. No, today we are talking about how buy now, pay later schemes are turning into a massive bubble ready to burst. One that parallels the 2008 housing bubble and financial crisis in so many ways.
Hey, there's a bubble.
How do you know?
Genuinely, going into this video, these parallels were only going to be a small part of my script, but once I started researching and realizing how deep all of this goes, I changed the script to fully focus on this piece. Because it is incredibly eerie how similar these bubbles are, and yet no one seems to be talking about it. So with that, let's talk about it. Let's talk about how buy now, pay later schemes are a massive debt bubble on the brink of bursting. Let's talk about how it's following the same footsteps of the 2008 housing crisis, and how if or when this bubble bursts, it is not just going to affect those who use buy now, pay later companies like Affirm or Klarna. No. Just like the Great Recession, this burst would impact everyone. If you're new here, I'm Cara and I make videos on the intersection of money, media, and culture. I've made a couple videos about buy now, pay later schemes, so check out my videos on those when you're done here. And if you want to support my work and this channel, please consider becoming a patron on Patreon. I try to be very picky with the brands that I work with on this channel, and I would love to build up my Patreon more so I can stay super picky. I also want to do a lot more with you guys on my Patreon, so things like exclusive content and early releases. Speaking of which, right now on Patreon, you can watch my video about the rise of AI influencers. I loved making this video. I think it's so fascinating. It's coming out next month, but you can watch it early as a patron with no ads right now. And since one of the things that we are talking about today is the illusion of affordability that buy now, pay later schemes trick you into believing, it feels very appropriate to shout out today's sponsor, Rocket Money. I've been working with and using Rocket Money myself for quite some time now, and I seriously think it is such a great tool to use if you are looking to get better with money. I know it can be intimidating to tackle personal finance, it can feel super confusing, but Rocket Money helps you make sense of your money and move you toward your goals. With Rocket Money, you can easily review your spending, analyze trends in your behavior, track and cancel subscriptions, automate your savings, and build a custom budget. They even have a concierge to help you lower your bills. They literally can scan what bills you're paying and connect you with or negotiate better rates for you. I'm a huge fan of tools that make personal finance more accessible for you guys, and Rocket Money is doing just that. So if you're interested in trying Rocket Money yourself, you can go to rocketmoney.com/Cara, that's C-A-R-A, or click the link down in my description below to get started for free. You can also unlock even more features with their premium offering, so go check out Rocket Money and use my link down below so they know that I sent you, and a big thank you to Rocket Money for sponsoring today's video. Alright, so when we're talking about buy now, pay later becoming a bubble, we have to look at who is being targeted, because it is classic for bubbles to form when risky debt is handed out to people who realistically can't pay it back. Why? Because when a bunch of people can't pay their debt back at once, a bubble bursts, and that is exactly what happened in the 2008 housing crisis. Mortgages for houses were handed out for people even if those people couldn't realistically pay off the loans. People with poor credit, no jobs, little income, no real ability to repay. They weren't just allowed to have what's called a subprime mortgage, they were often targeted to buy those. I'll keep bringing up The Big Short in this video because it is one of my favorite movies, but also because they have a scene that depicts this kind of targeting taking place.
I focus on the immigrants, you know? Once they find out they're getting a home, they sign where you tell them to sign. Don't ask questions, don't understand the rates.
And you target immigrants too.
Their credit actually isn't bad enough for him.
Just like subprime mortgages targeted financially vulnerable people before the 2008 crash, buy now, pay later is doing the exact same thing today. Companies like Affirm, Afterpay, and Klarna have a big selling point. You do not need good credit to use them. Some of them may say that they'll run a soft credit check, but that's not always the case. The reality is that buy now, pay later mostly attracts users with bad credit. In a consumer finance report this year, the CFPB found that the majority of buy now, pay later users had subprime or deep steep subprime credit scores, meaning they are risky borrowers that are less likely to pay back a loan. The scary thing about attracting people who are risky borrowers is that if they don't pay back the loan on time, they are going to get hit with late charges, overdraft fees, and interest payments. In a Stanford Business School article on the hidden costs of buy now pay later plans, Stanford professor Ed DeHaan explains, quote, "The average effect of using buy now pay later is negative, which is surprising. It's a relatively small negative number, but likely meaningful for many people who live paycheck to paycheck." We're not saying that this is all doom and gloom. We're just saying that, like every other consumer credit product, buy now pay later warrants careful academic and regulatory attention, and most likely also warrants regulation. This is how I feel about buy now pay later too. I do think it's good for people with bad credit to have a way to build up their credit scores. And just like credit cards, buy now pay later plans can be a great tool if you're financially literate and you're financially stable. But what scares me about buy now pay later is that it's designed in a way that promotes the illusion of affordability. This is the situation. You target people who have bad credit and might have poor financial literacy. You give them credit in this clever way that makes the payments feel small, and then you hit them with huge interest rates and fees if they don't pay on time.
Damn! 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 Damn!
In behavioral economics, there's a concept known as the pain of paying. When we spend money on something, we feel pain. The bigger the purchase, the more the pain, and that pain signal helps keep our spending in check. But at the same time, that pain signal can be dulled with certain tricks from financial companies, like how spending with a credit card feels less painful than spending with cash, or spending with Apple Pay feels less painful than a physical card, or how with buy now pay later, breaking up a payment and pushing most of it off to another day feels way less painful than buying it up front.
What's Afterpay?
It's like if you could eat the whole tub of ice cream and spread the calories over 6 weeks.
What results is a disconnect between the act of buying from the act of paying. This makes it easy for us to believe that anything we want is affordable. It's only $10 here, $30 there. But those payments come again and again. Not only that, they stack up on top of each other until you are weighed down by charges you can't keep track of, spending more than you should. In an Atlantic article on the topic, the author shares a study that found buy now pay later causes a permanent increase in total spending, stretching the average household retail budget 30%. This illusion of affordability is a real problem for buy now pay later users. And you might say, hey, we've had layaway programs for decades. This isn't something new. But the big difference between layaway programs and buy now pay later is the buy now part. The stakes are entirely different. With a layaway program, you pay in installments in order to finally receive the product. If you can't afford a layaway payment, the worst case scenario is that you just don't get the product. It sucks, yeah, but it won't send you down a spiral of debt the way buy now pay later plans potentially can. Because with buy now pay later, you already got the product. If you give it back, it is used now and not worth the same amount. So you need to either pay up or face the wrath of their penalty costs. It's like taking money from the mob. If you do not pay up, they're coming after you, which is exactly what can push our buy now pay later bubble to burst. In 2008, the housing bubble popped because countless people who'd been given subprime mortgages were not able to pay off their home loans after their teaser rates ended, which in turn caused a chain reaction. It not only negatively affected homeowners, but retirees, workers, and anyone with money in the stock market. I think something very similar could happen with buy now pay later loans. Maybe not on the same scale, but nevertheless, I think we have a very dangerous bubble forming. Buy now pay later users already face the psychological trick of reduced pay pain, meaning that they might unintentionally stack up Klarna or Affirm payments without being able to actually pay them off down the line. In a recent Bankrate survey, it was found that about half of buy now pay later users already have experienced issues like overspending and missing payments. On top of that, we are seeing a macroeconomic environment full of uncertainty, layoffs, job losses. When those things happen, people have less money for their bills. They might miss more payments. They might rack up late fees and interest, potentially sending them further and further into debt. Unfortunately, it might be quite like 2008. And this is exactly what made me want to dedicate this video to the bubble parallels, because it seems like the way that buy now pay later is evolving could have ripple effects far beyond the individual shoppers who can't pay back their debt. Because what's happening now is something called securitization. That is when buy now pay later companies like Affirm bundle up the debt their users take on and sell it off to big investment firms, including companies like Prudential, where it ends up in things like like pension funds and insurance portfolios. If that sounds familiar, it should, because that is what happened in 2008. Risky debt was repackaged and sold as safe investments. So when risky borrowers started defaulting on their mortgages, they didn't just lose everything, it impacted everyone. So to recap, what am I saying here? I'm saying that buy now, pay later mostly attracts people whose credit scores show they are not great at paying back loans. They then lure them into a system that will likely make them overspend, making it even harder to pay back those loans. And then they sell those loans to investment firms, meaning if the loans are never paid off, other people's investments will go down with them. Like I said, a bubble. So knowing this, are we doing anything to prevent a bubble from bursting? Unfortunately, not quite. At first we kind of were, but now not so much. See, in recent years, the Consumer Financial Protection Bureau was starting to regulate the buy now, pay later industry more to make the regulations and protections closer to what we see with credit cards. This year, though, under the Trump administration, we're seeing many of those protective rules and regulations get rolled back. This means less oversight, fewer protections to keep consumers out of debt, and in my opinion, more chances for the buy now, pay later bubble to burst. With that in mind, if you are someone who uses buy now, pay later plans, remember to be careful and keep tabs on where your money is going. It is so easy to kick the can down the road with systems like Klarna or Afterpay, but their systems are designed to encourage spending beyond your means. My rule is that if you can't afford something twice, don't even buy it once. As tempting as it might be, avoid using buy now, pay later for small things like groceries or takeout. I'd argue it's best for big purchases like furniture or a computer, and only if you can truly afford it to begin with. Like I said earlier, tools like buy now, pay later plans or credit cards can be really good if you're financially literate and in a financially stable place. But if you are not, these systems can be a stepping stone to a devastating debt trap. So know where your money is going and do not spend beyond your means. But what do you guys think? Do you agree that buy now, pay later is a bubble and that it's about to burst? Are you someone who embraces or rejects buy now, pay later? Let me know your thoughts in the comments down below and what topics you want to see me cover next. A huge thank you to my patrons on Patreon. If you want to become a patron, you can go check out the link down below. And also thank you for the one-time donations on Buy Me a Coffee. I appreciate you guys. If you want to see more, go check out my video on the buy now, pay later trap, and I will see you guys next time. Thank you for watching. Bye!